Hello guys, today we're going to talk about 10 data points that you should keep in mind when keeping a trading journal. Alright, let's get started. So the first data point you should keep in mind is the basic information about your trade. This is the symbol, the entry price, the exit price, the open date, the close date, and always you should keep track of your stop losses. If there is something that you can control when you're trading, is the risk. How much you're willing to lose. This is why it's very important for you to keep a track of your stop losses, as well as your target. It is very important that before you enter a trade, you should keep in mind what's your target. So when you hit that target, you should exit and close a trade. You should as well keep track of your commissions. What happens very often, especially for new traders, is that they keep trading very often, but they're not keeping track of their commissions. So at the very end, what ends up happening is that they're making money, they have some profits in the trades, but the commissions are greater than the profits that they're making from their trades. So this is why it's very important to keep track of their commissions, to make sure that you're actually making money from your trades. All right, keep going. The market condition. It is very important that you somehow journal what were the market's conditions when you place a trade. For example, were there a market trend? What were the volumes that you were trading? And if that sector that you were trading, or that scene where you place a trade, represented a hot industry for that moment. Okay, so this again is very important, since the market's conditions will also reflect on the move in the price action of the symbol of the stock. Okay, next is the market sentiment. So when you were trading this stock, was there any hot topic, or were there any world trends? For example, we could be trading marijuana stocks. Right now we're in 2017, the marijuana stocks are very hot right now. Or especially, for example, if you're in Canada. If you're in Canada, the marijuana is now becoming legal. So this is a very important stock that you could be trading here, since you know that it might potentially go up. Okay. Sector movements. So this is a very related to the point above. Let's take oil, for example. When the oil went down, so this is a sector movement. All the oil stocks are going down. So this is something that we should keep in mind when we're trading. If all the oil stocks are going down and we just place a trade that hoping that the stock will go up, well, we're going against the sector movements. So this is something again that we should journal, we should keep track, because maybe we're placing trades that are going against the sector movement, and we could find out later that there is a correlation between our losses and the negative sector movements. So this is again important to keep track. The instrument price actions. So it is important to record any important or significant price actions in the symbol. For example, is this a 52 weeks high or low? What happens with this is that, suppose this is a 52 weeks high. If this is a 52 week high, then in other traders' computer, they're gonna get an alert saying that this is a 52 weeks high. So these stocks, or will be more likely to, let's say, to go up because it's a 52 weeks high. So again, it's important to record what price action made us make that trade at that moment. Okay. Any fundamental analysis. Were there any significant changes to the company structure? For example, we could be trading in Twitter, and let's suppose that the Twitter CEO resigned from their position. If the Twitter CEO resigned from the position, we could assume that the stock will go down. All right. So based on this, if we're making a trade betting on this decision, then this is a significant fundamental analysis that we should write down in our trading journal. Trade expectations. So what were we expecting when we place a trade? So maybe we're expecting the price action to move in a certain way. Maybe we're expecting to hit some other measures from our technical analysis. What were we expecting when we enter in this trade? It is very important for us to record all those expectations, so when we conclude the trade, when we close the trade, we can take a look back and we see, okay, well, these were our expectations, and did we meet those expectations or not? After the trade it's closed, what happened? Did the trade go as you expected? We need to write that down. And if it didn't go as you expected, why do you think it didn't go as you expected? We need to unload all that information in our trade journal. So what happened? When we unload that information, when we transfer the information from our brain to our trading journal, it could be writing it down in a paper or writing it down in an online trading journal like TradeSync. It helps us internalize that information. It helps us think whether or not we were making the right decision or not. Okay, so what happened again? We need to also record whether we made a profit or not, because very often I see traders making a lot of trades thinking that they might be having a positive cash flow, but at the very end they're actually losing money, maybe because their commissions are taking over, or maybe they're just not making enough profits. Your emotions. This is again very important. Very often we focus purely on the strategy, on a strategy that we learn online for somewhere, but what we don't take into account is our psychology. Our psychology accounts for 80%, at least for 80% of our potential performance. So what happens if you don't take into account that 80%, if we just focus on the strategy, what we are only aiming for a 20% success. So what happened with the psychology? Emotions very often override our rational decisions. For example, let's suppose I trade Google today for $1, and tomorrow the stock was at $2. But what happens? The stock was at $2, so I get too excited. When I get too excited, I probably won't exit the trade, because I'm saying, okay, well, I want the trade to go to $4 now that it's at $2, because I already made 100% of my money, but maybe I can make 400% of my money, right? So I get too excited. So instead of exiting, instead of following my plan, I stay on that trade, and then maybe what happened is at the end that the stock, instead of still go up, it went down. So instead of being at $2, it went to 0.5. So I end up losing money. So it's very important to record what emotions made us place that trade, and what emotions made us stay on the trade, and if there is any emotions that we felt when exiting the trade, when closing the trade. Okay. Your risk. As I mentioned at the beginning, the only thing we can control when trading the market is how much we're willing to lose. So it's very important to keep track of our risk and our risk-reward ratio. For example, I see very often traders that go in a trade just because it's hot. Everyone is placing trades on, let's say, Google, and what ends up happening is that their risk-reward is 1-on-1. So that's not a good risk-reward. The risk-reward should be at least 1-on-2, right? So these are all the 10 data points that you should keep track in your trade journal. Now I'm going to show you how TradeSync can help you record all those 10 data points, so you can easily keep track of those. So here we are on TradeSync. So I'm going to show you how you can quickly control all those data points and put them into your journal. You simply click add into a trade. So when you add into a trade, let's say we place a trade on Google. We place it today. We put the time. It's very important that we put the time. So let's say 10 a.m. And then we put the price, for example, $1. How many shares did we place on that trade? And what commissions? Again, it's very important to put the commissions. And what date did we exit that trade? Say 12. Say we exit at $2. Say 100 shares, and the commission 9.95. and we save a trade. Okay, so that easy. In just a couple of seconds, I was able to track all these first data points. Okay, so I can come back here anytime and I can remember, okay, I enter at this point, I exit at this point, and what this is going to allow me then to do in the future is it's going to allow me to data mine my trading journal. And by data mining my trading journal, I can find out what I'm doing right, what I'm doing wrong, and how can I improve my trading. And we should also add our setups. Let's say we were this is a former, what we call a former runner, so we will tag the trade with the proper setup. If we end up losing money, if we losing money, we should record any mistake, so we can again data mine that and know what exactly what we're doing right and what we're doing wrong. We should record our stop losses. So 0.5 in this case was my stop losses, and we should here place a note about market movement, any risk reward ratio, and all the other points that we talked about. You could simply just put in the notes here. And of course, you can upload any images to help you understand why you took that decision that you took. So we close this. Once we close this, then we have all the information right on the cloud, so we can access it from anywhere. And again, we can data mine this information and in the future understand how can we improve our performance. So again, thank you again. This is another quick video showing you how to keep 10 data points to make a good trading journal. Thank you for watching.